Hey guys! If you're new to Canada or have been in Canada for a while, there is a very important deadline that's coming up that is important to remember. It's April 30th, the tax deadline. And if you're just planning on moving to Canada, this video is going to help you get an intro to the tax system in Canada. Hello everyone, my name is Anastasia and welcome to the channel Make That Change. In this channel we talk about moving to Canada and building a new life here in the new country. In this video we're going to talk about sales tax, income tax, how to file for your income tax return, and how you can save on filing your taxes. There are three main ideas that I want to bring across in this video, and it's going to be helpful to newcomers as well as for people who have been here in Canada for a while. So first, your income tax depends on how much money you actually make. The more money you make, the more tax you will pay. Second, if you're self-employed, there are so many ways to reduce your taxable income, legally of course. And third, for those of you who are very new to Canada, sales tax works differently in Canada, meaning that it's not advertised on the goods and services, so you always have to do a little bit of the mental mathematics to actually get the price. And before we proceed, I'd like to highlight that this video is not intended to give you a financial advice. This video is just meant to inform and educate you on what the overall general tax system looks like in Canada. And this is the type of the information that I wish I knew when I just moved to Canada. The governing body for everything taxes in Canada is Canada Revenue Agency, or CRA. You can create an account on the CRA website and access some of your past tax returns, view your notice of assessment, or even just change an address if you've moved. Alright, so I'd like to get into our first major step and talk about the sales tax. The reason why I want to talk about it is because the way the sales tax works here in Canada was very surprising to me as a Russian citizen, and I'm gonna tell you why. So whenever we buy goods or services, the seller always charges sales tax on our purchase. It's always the case, but depending on the country that you come from, your sales tax may or may not be advertised in the price that you see on the good or service. For instance, in Europe, whatever the price that you see on the price tag is the price that you actually pay. This is done for many reasons, one of them being so that the consumer knows exactly how much money goes to the seller and how much money goes to the government. Depending on which province you're buying your goods and services in, you may have to pay anywhere between 5 to 15% in sales tax. The sales tax consists of two components. There's the federal tax, determined by the Government of Canada, and then there's the provincial tax, which differs depending on which province you're in. The federal tax is referred to as Goods and Services Tax, or GST. The total GST tax rate for all provinces in Canada is 5%. When it comes to provincial tax, each province decides which amount of tax they would like to collect. For instance, Alberta has chosen to have zero tax. So when you're shopping online, your final tax is calculated upon checkout. So don't fully rely on those prices that are just advertised on the first page of the online store. There are some exceptions for businesses that are small suppliers that sell medical devices, provide childcare services or teaching lessons, and even some basic groceries don't require tax. There are different types of income, and I think it's important to start this section with listing what the different types of income are. And the reason why it's so important is because different types of income are taxed differently. The most common type of income is employment income. That's the type of the income that you get when you work for a company, be it full-time or part-time. If you work as a waiter or at any kind of service that gives you tips, tips is also considered employment income. Employment income is subject to the biggest income tax. Yes, that is right. The tax you pay on the salary is the highest among all of the other different types of income that you may have. I'll pause here. Think about it. If you're an official employee at a company, meaning that you're not on a contract and you're not a consultant, your employer is required to withdraw any income tax upon every single paycheck, and they're also expected to send that amount of money to the CRA. Once a year, around end of February or March, your employer is supposed to issue a T4 slip. It's a record of how much money you've made in total with that employer and how much money they've withheld for the income tax. So, what are other types of income? Self-employed income. So let's say you don't want to work for a company, or anyone for that matter, and you decide to become an Uber driver, a delivery man, or maybe you're an expert at something and you decide to start consulting services and educating and consulting people on business, marketing, or anything, you name it. Well, in that case, you're considered self-employed. In other cases, you might be working for a company, but you might be considered a consultant or a contractor. In that case, you will also be considered self-employed. The income you make is taxed as employment income, except you file your net income. And this is a very important concept to understand. If you work for a company and are considered an employee, and you drive to work every single day, you cannot use this to expense from your employment income. And that is because the salary that the employer pays you is kind of covering all of that. However, if you're self-employed and you legitimately use your car to conduct your business, in the case of, let's say, a construction contractor or a real estate agent, you can deduct the costs of your car from your yearly taxable income. The next type of income I want to talk about is investment income. Investment income is the income that you make on the various investments or assets that you have. Such things could be things like dividend income, interest income, rental property income, or income from a sale of an asset. Dividend income is the type of income where if you hold shares in the company and it makes profits, they pay you a tiny portion of that profit as dividends. Since Canadian companies already pay corporate tax on their profits, this often results in a reduced rate of tax on your dividend income. Usually, you will receive a T5 or other information slip stating the amount of dividends you have earned through your investment bank. Next, there's interest income. Interest income is the income that you make based on the deposits that you have accrued if you hold some bonds, savings, or deposit in a bank account. Let's say you have $10,000 and you deposit it on a high-interest savings account. You could typically earn up to 3% interest on that deposit. That means that your $10,000 could turn into $10,300 in a matter of a year. You would also have to pay tax on that interest that you've earned. In order to know the amount of total interest that you have earned on all your deposits, you will receive a T5 form from the institution where your deposits are held. Rental income is the income that you make based on renting your property as a business. It can be an extra apartment you own, or maybe a room you're renting out in the home you own. Similarly to income from self-employment, you pay tax on the revenue received minus the expenses of operating the business. Such expenses could be maintenance or repairs or financing costs, property taxes, or your property insurance. The last type of income that we'll talk about is capital gains. Capital gains is the profit that you make based on selling your asset, be it your shares or a home that you sell. Usually, you pay tax only when the property is actually sold. So if you make $100,000 thanks to the appreciation of your property or your nice apartment in Toronto, let's say, you will only pay tax on the $50,000 and then you'll pocket the other $50,000. Now, let's talk about what all of this means to you. In most cases, when people move to Canada, they will look for an employment, and therefore most of us will end up paying employment income tax. In Canada, each member of the household who has income is responsible for filing his or her own taxes. You and your spouse, for example, will each have to file your own tax return. If you have a teenage child who works part-time somewhere, they will also be responsible for filing their own tax return. And if you're a newcomer and you've only been in Canada for part of that tax year, you will still have to file your tax return for that specific part of the year. First, let's talk about the two components of your income tax. There are two types of taxes you pay. There's federal and provincial, also called territorial tax. The federal income tax is something that remains constant no matter which province you're in, similarly to how the sales tax works. The federal tax brackets are also different from provincial ones. How much tax you'll pay is determined by where you live in Canada and how much income you declare from all sources. Importantly, your provincial rate is determined by the province you're living in on December 31st of the tax year. So let's take my example. About 2 years ago, I moved from Quebec into Ontario, and I did my move in September. So in the end of that year, I filed my taxes under Ontario, even though my first 9 months was spent in Quebec. This means that if you're thinking of moving to Canada, I would highly recommend you study the amount of income tax that you would pay in each province and the amount of sales tax that you'd have to pay. And if you're planning on being in the high income bracket, you could save up to 10% of your income in taxes just by choosing the right province to live in. Now, let's break down what those tax brackets are. Let's start with federal tax brackets. According to the Canada Revenue website, the federal income tax brackets for 2020 were the following. It is important to understand what brackets actually mean. Think about them as buckets to fill. So looking at the first line here, your first bucket is $48,000 and it is taxed at 15%. This means that if you make up to that amount of money, you'll get taxed at 15%. Now, let's assume that you're making $100K. The way the system works is that the first $48K you make will be taxed at 15%, but then your bucket will be filled, so you'll have the other $52K that will fall under the second income tax bracket, which is taxed at 20.5% now. Again, the tax brackets are like buckets that get filled with income. If you fill the second bucket, whatever the amount of money, even if it's $1,000, that money that remains will have to go into the next, higher tax bracket. Now, let's take a look at provincial taxes. The scheme is pretty much the same, except the tax rate and the brackets are different. So let's take Ontario as an example. And by the way, you can find all of that information on the Ontario Revenue website, which I will link in the comments below. So going back, this is the Ontario example for tax brackets. So here, if you make $100K, you will pay 5% on your first $40K in provincial taxes, and then you'll pay 9.15% tax on the next $44K, and then you will pay 11% for the $12K remaining. Now, trying to compute all of that could be a big brain explosion. So the simpler way to calculate how much tax you will pay in different provinces and different amounts of income is to use a tax calculator. I will leave a few links to the really good tax calculators in the description below. Now, before we move on to how to file your taxes, the biggest takeaway that I would like to highlight is that the amount of income tax that you pay will differ based on the amount of money that you make and based on which province you actually live. So now that we know that the income tax deadline is April 30th, we also know what types of income that we have to pay taxes for, and we also know what our approximate tax brackets are. Now let's talk about how to file your income tax. Make sure you start your tax return in advance. Don't wait until April 30th to file your tax. Don't leave it to the last minute, because you might end up paying penalties in case it turns out that you owe taxes to the Canadian government. You can file your tax return as early as the beginning of March. Next, know what to report and claim. Make sure that you have all your T4 slips available and documentation supporting any tax credits you might file for, deductions or assets that you want to declare. If, for whatever reason, you cannot obtain your T4 from your employer, for instance, you've moved and you couldn't receive it, you can always register on CRA website and verify your T4 there. It will always be there. Next, keep your CRA information up to date. For instance, if you moved, make sure your most recent address is updated, because you don't want your tax refund check to be sent to the wrong person, right? I know, right now actually, the online address service has been offline for several months now. So when I moved last September, I had to call CRA directly to ask them to change my address. Also, be prepared to answer questions about your previous tax reports as part of their identity verification process. And if you want to get your tax return deposited directly onto your bank account, make sure to add your direct deposit bank information on the CRA website. Now that you have all of that stuff together, now it's time to decide how will you be filing your taxes. There are several ways to do that depending on how much headache or hassle you want to have and how much money you're willing to pay to file your taxes. The very first way is to file your taxes manually. You can download the tax forms from the CRA website or get them ordered and mailed to you. For that method, you actually have to understand how to fill out the taxing forms. So if you're a newcomer and you're afraid of messing things up, I would not recommend to use this method. If you have a little bit of money and you're willing to pay for you to file your taxes, you can hire an accountant who will help you do that. What they will do is they will collect all the information necessary, and they can also give you some guidance and recommendations on how you could save on your taxes. Accountants typically know all the latest changes to the tax system, and they can also file taxes on your behalf. But if you don't want to pay for the accountant and still want to walk through part of the process yourself, you can use multiple certified online services of filing taxes. Some examples would be TurboTax, Simple Tax. I personally use UFile. These systems walk you step by step through every single information that you need to input for your tax declaration. Tax clinics are the community places where volunteers are trained specifically to help you out to file your taxes. All you need to do is bring all your receipts and income slips, as well as have your SIN number in handy. Typically, you will know right away how much tax refund you can get or how much money you owe to the government in Canada. If you end up owing the money to the government of Canada, you will have to pay all the balances due by April 30th of that tax year. If the government of Canada owes you money or a tax refund, in that case, it can take all the way up to a couple of months for the money to hit your bank account or be sent by mail. Now, you might be scared and wondering, what are some of the cases in which I will owe money to the Canadian government? Well, that might happen in case where there's a difference between the amount of tax that you owe versus the amount of tax that has been withheld for you. You could be self-employed and no one is withholding tax for you. Or you might have changed jobs through the year and your employer did not adjust for that. Or you could have made an RRSP withdrawal. Or you had other unexpected lump sum payments with no tax withheld. There are a number of situations in which Government of Canada tries to reduce the tax burden for those who have some special circumstances or lower income. There's a number of tax credits that can be applied to reduce your taxable income or maybe to entice you to do certain things. For instance, there are some tax deductions if you contribute to an RRSP or buy a home because the Government of Canada wants you to do so. Now, let's go through the list of all the possible deductions, or almost all the possible deductions that you can have. So RRSP, I've just mentioned that one, but basically it's the pension contribution that is deposited on your savings account and left sitting there until you retire. Then there's also medical expenses. It's one of the most underutilized tax credits. Not many know that, but you can claim tax deductions for the fees you've paid for hospital services, prescription drugs, insurance premiums, or even your contact lenses. Next, childcare expenses. This is a non-taxable benefit for each eligible family to cover the cost of raising children under the age of 18. You can get those deductions for daycare and babysitters or birth-related medical expenses. The same expense can be declared if you're caring after a dependent, and you can get deductions related to that too. There's also moving expenses. Individuals who have moved and established a new home, to be employed or to run a business at a new location, are also entitled to deduct eligible moving expenses. You may be eligible for the deduction if the new home is at least 40 kilometers closer to your new place of work than the prior location. If you're a student, you can also deduct your student loan interest. Both federal and most provincial governments cooperate to offer students grants and loans to students in financial need. So when a loan is offered and interest is accrued, you can claim a deduction for all the interest amount that you've paid in that year. Then there's also new COVID-related information. You can claim deductions related to work from home during COVID-19 pandemic. And there are two ways to do so. There is a temporary flat rate method and detailed method. In case with flat rate method, you can claim $2 per each day you worked from home during the pandemic period in 2020, and it could go up to $400 in total. In case with detailed method, you'd need to sit down and do some calculations and have receipts ready. You can also claim expenses such as utilities, internet and telephone bill, rent and minor repairs to your office space. For more COVID-related information, I will provide some link in the description below. And that's it for today. The topic is vast and I've had a lot of information to cover, but I hope it's enough to just understand some of the basics of tax system in Canada. And some of the topics we covered deserve a whole new separate video. Please let me know in the comments below which topics you would like for me to cover next, and I'll be happy to do so. And if you found this video useful and you want to support us, please leave a comment below, hit that like button, and subscribe to our channel. Your likes and feedback inspire us more than anything. And that's it. Bye for now and see you in the next video. Take care.